The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hello, everybody. This is the Tax Lady. And I'm sure you're like heating up those W-2s right now and them 1099s, and you're getting ready to file your taxes. And we're really in the midst of tax season. I have my Gombade, Chris Fabian. I got him out of the office with me. Hey, Chris.
Hello, Esther.
How are you?
I'm doing good.
This is respite in the midst of the storm here, because we have to go back and work till 9 o'clock tonight. All of our offices are open tonight till 9. Monday through Friday this week, 9 to 9. It's next Saturday, 9 to 9.
Yep.
On Sunday, if you're a Sunday person, we do have 3 mall offices that are open to serve you. The rest of us are going to be sleeping, I'm going to tell you. The mall offices.
We have the
Boulevard Mall.
McKinley Mall.
Yep.
Right in front of where Orange Theory is now, right behind Orange Theory. We are in the Boulevard Mall by Dick's Sporting Goods. And then we're at the Factory Outlet Mall. I know it's not called the Fashion Outlet now. In the alcove in front of the mall.
Right. In an outpost.
In an outpost, all by ourselves.
Right. So if you wanted to pop in on Sunday and get your taxes prepared at those 3 offices, but the rest of us will be there, very happy to help you. And we answer tax questions all day long with real live people. So if you have questions off the show, but obviously during the show, you can call us 803-0930. 803-0930, star 930 on a cell phone. We would love to talk to you. Your questions are what makes the show so interesting. We always have a topic, and you can get off topic when you call in. Again, 803-0930, 803-0930, star 930 on a cell phone. We have offices from as north as Lewiston all the way down to Fredonia. And from the Lake Erie shoreline on the west side all the way almost up to
Batavia.
Past Batavia, right? Yeah, that's right, to Batavia.
Batavia,
yeah.
Medina, Newfane.
Right. Yeah, all up there. So, we love you. We want to serve you. We think we do a really great job. Our prices are very reasonable. We do everything everybody else does, but just for about half the price,
yep.
Right? And let's talk about this. We're talking about, people say, I love listening to your show because I learned so much about taxes. We're talking about how when everybody's talking about what tax bracket you're in and what tax rates you're paying, what I don't think people realize is there's all kinds of different types of income that's taxed differently, and it really isn't necessarily part of your taxable income and your tax rates. And I thought we'd talk about that today. Like, for instance, under ordinary income that would be taxed at taxable income would be wages.
Correct.
Right?
Yep.
Interest income, unless it's municipal bond interest, right?
Right.
Because if it's a municipal bond, tax-free, right? Pensions are taxed at ordinary income, except for New York State, because if you are over the age of 59 and a half, how much is tax-free?
Well, on a normal pension, it's first $20,000. If it's a government pension, it's all tax-free.
And if it's an IRA,
no matter how old you are.
Right, and if it's an IRA,
same rules apply.
The combined pensions in IRA, if they're not publicly funded pensions, would be $20,000 per you and your spouse. So it'd be 20 you, 20 spouse. So completely tax-free in the state of New York. Taxable Social Security is taxed at ordinary rates, right?
Yep.
A lot of people don't realize that their Social Security can be taxable. And this is how it works. It's all of your income plus half of your Social Security is added together. And if that figure comes to over $32,000 or $25,000 if you're married filing a joint return, then the excess over those 2 floors is half taxable, up to 85%. So if you have a large pension, large other income, you could pay 85% on your Social Security after that computation, and it's taxed as ordinary income.
Correct.
Right?
Yep.
Gains from the sale of 1245 assets. Now, what does that mean?
That means you're depreciable. You're like your computer. If you're writing off your computer, if you're writing off
Your
a
truck.
desk, your car.
Your car.
Yep.
So, they said now you cannot do 1031 exchanges for anything but
Other than houses.
So it leads me to believe that if somebody's trading in a company vehicle now, it doesn't look like you can adjust the basis because that would be a 1031 exchange, which would mean now under tax law changes in 2018, that 1245 asset would be recaptured as ordinary income, which would be interesting, right?
Yep.
Whereas before it wasn't taxable at all. Unemployment is taxable as ordinary income.
Right.
And a lot of people don't know that their unemployment is not mailed to you unless you call and ask for it.
Correct.
So where do you get it from?
You got to go online and print it. You got to remember your username and password.
Right. And I know when you come in our offices, we'll do that for you. State refunds are taxable after a computation. What does that mean, Chris?
Well, I mean, your New York State refund could be taxable. First of all, you got to look to see if you itemized last year. If you did you use your sales tax or did you use your income tax withholding? If you use sales tax, then your state refund's tax-free. But if you used your income tax, then you have to look to see if you had any refundable credits from New York State to offset your New York refund. So if you had $1,000 back, you had a $660 Empire child credit. That would mean only $340 of your $1,000 would be taxable. On
so you got to do. And for those of you that have been taxing yourself on the whole thing, probably in most of your cases it isn't taxable at all.
Right.
Right. The other thing that's taxed as ordinary income would be alimony that you receive, right?
Yep.
And short-term capital gains.
Yep.
So those things are taxed as ordinary income. Now, we're going to talk on the other side of the break, and I know we got people holding. Rose and Mike, 8030930, 8030930, star 930 on the cell phone. We're going to talk to our callers. We're going to tell you about the other kinds of income tax differently on the other side of the break. See you in a minute.
And you're gone too far, 'cause you know it don't matter anyway. You can rely
On the old man's money? No, you can't rely on the old man's money. You got to rely on your own money, and that's what we're talking about, taxes and your finances. And I'm joined in studio with Chris Fabian. I'm Esther Gullius, the tax lady from EG Tax, and we've made Rose wait too long. Rose, how can we help you?
Hi, Esther. I was just calling because we paid our town and county property taxes for 2018 late last year.
Yep.
And we have the tax bill in front of us now.
You got the warrant, right?
Pardon me?
You got the warrant.
What's the warrant?
That's what they call the tax bill.
Oh, okay, got that. And on it says paid 12/26/17.
Mm-hmm.
So we'd like to include that on our 2017 tax return.
Yeah.
That?
Yeah. That was the whole point of it. The governor did an executive order towards the end of the year because he knew that New Yorkers were going to get their hides skinned next year because of the limitation on property taxes. So he did the executive order that if the town that you lived in issued the warrant and you paid the taxes before 12/31, that you'd be able to deduct it on your 2017 return.
Now, how do we know this was warranted? The bill came, we went to the office and we paid it in our town hall. And then we got the bill maybe a week later, marked paid December 26, 2017.
Okay, well, that should suffice.
Right. Erie County did release the warrant on 12/26, late on 12/26. So most municipalities are in good shape. I know there was one in Niagara County that had no clue on what to do, so they were refusing people. Right. But you will be in good shape.
Yeah, but if you just went down there and threw some money at them and they took it, that wouldn't work. It's really got to be a bill, and you got a bill, so you're good to go.
Okay. Well, thanks so much.
All right, thanks, dear. Bye-bye. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone, and we got Mike. Hey, Mike, how can we help you, sir?
Hi, Esther. I have two kind of related questions. I have a New York State pension. I'm 65, but I'm not taking my Social Security benefits yet because some people said to wait. I don't know if that's correct or not in your opinion, but, whatever.
Right, whatever.
The other question I have is based on the future tax issues, the way that this new tax program is, what is the best way to handle 401ks and 403bs is it best to take it out as a lump sum, little by little, or to change all of that to a Roth thing? Because I have quite a substantial amount.
Look at Mike. If let's say you had $300,000,
Okay.
and you put it all in a Roth,
Okay.
right? So you're going to pay just about, let's say,
$100,000.
Well, I was going to say 40%. So he's going to pay about $120,000 in federal taxes, and on New York State taxes, you're going to pay about $21,000. So you're going to pay about $141,000 on your $300,000. Does that sound smart to you?
No.
Okay. It does not sound smart to me either. I mean, every time you take money out of one of your taxable pensions, I love listening to some people that don't know how to do taxes or understand tax, and they say, we can make it so you can take your money out tax-free. Just roll it into a Roth. Yeah, you pay the taxes now. And so later on, it isn't taxable. With the new increased standard deduction, nobody's going to pay taxes till they get to about over 65, till they get to about $27,000. That means if you're diligent and you're taking out $20-some thousand a year out of those 401ks, you're not going to pay taxes on it at all. So people that are rolling into Roth so that they don't have to pay taxes, if they did some tax planning, they'd get the deduction and it wouldn't be taxable. Okay.
Okay. My other question about the Social Security, is it better to take it now or wait?
Are you retired, Mike?
Yes, I am.
Okay. So
state pension, and right now I'm 65, going on 66. I'll be 66 in a month.
Okay. So you have a New York State pension, you said, right? And that's how you're living?
Currently, yes.
Okay. Well, the thing is, the growth, yes, there's an 8% growth a year, which is great. But what you have to think, and it's hard to think like this, is that's an 8% growth on imaginary money. Okay? Because if you were to die,
you got to live long enough to get it.
If you were to die at 67, your heirs aren't going to get that money that you didn't collect.
So let me give you an example. Let's say that you would be able to collect $3,000 a month for 12 months. That would be $36,000 for 4 years. That's $144,000 that you're leaving on the table. Now, if you live, and by the way, at your 8%, that would be 32% increase on the 3. So that would be about $10,000 extra a year. So you have to live 14.4 years longer than 70 to 84.4 to break even. So knock yourself out.
Okay. Thank you very much.
All right. Thank you. Bye-bye.
And
I know it goes against what everybody says, but it's the truth. And I know everybody thinks they're going to live forever, but I don't know. As far as I know, 100% of the people die 100% of the time.
Right. And I know 95% of the time, Social Security wins when somebody waits.
Right. And you've talked to Social Security.
And I've talked to Social Security.
On the QT.
Yep.
Right. They said, we hope they wait.
Yep.
Because we win.
They're a casino.
All right. Let's see. Let's go back to the phones, and we got Mike. Hey, Mike. How can we help you, sir?
Hi. A few months ago, last year, we got $165. I don't know if they call it a rebate.
Yeah, on your property taxes, right?
The prep for the
yeah.
Or if the school did something.
Mm-hmm.
No, that's not taxable, is it?
Do you itemize, Mike?
No.
Then you don't have to worry about it.
Okay, but they don't consider that income.
No.
The other already was paid.
Right. No. If you itemized, for those who do itemize and are listening, you have to back that off your property taxes.
Right. So you couldn't take a full deduction this year if you're itemizing when they had given you, let's say, $200. You would reduce your deductible property taxes by that $200, and that's how you'd handle it.
Yeah, because we just take the standard deduction.
Right. You're good. Okay, Mike? Thanks for calling. I guess Mike hung up. Okay, let's see. We're going to go to Mark in North Tonawanda. Hey, Mark.
Hello, Esther.
Hi.
You guys do a great job.
Thank you
so much for your help with everything.
Well, it's my pleasure. I mean, I love helping people, and I know we kind of take an unconventional look at some of the things because we really understand the tax implications, So forgive me if I've offended anybody, but I love what I do. What can I help you with, sir?
Well, a couple people asked questions that I was already thinking, and including the last guy, about that rebate we got.
Yep.
Our illustrious governor gave us back our money But
That's true.
or King Cuomo, as I like to call him. Anyway, as far as I prepaid some taxes, and they gave me a receipt.
Good.
I don't know. Would that count necessarily, or
That that would count. You could ask the county, or you could ask your town. I'm sorry, for the appropriate bill for the backup, but your receipt would count. Yes.
okay? And then earlier in the I caught some of your opening about what was taxed and what wasn't. A person collecting a pension. My wife's going to get a small pension when she retires. Is all of that taxable, or is a portion of it?
Okay, so if she's collecting a pension, all right, that she didn't contribute to, then that's going to be fully taxable on the federal. However, on New York State, you get to back off if it's a non-publicly funded pension, like city, state, county worker. Okay, if that's, in other words, those people, their pensions are fully tax-free on the state forever. Okay, regardless of their age, but in a non-publicly funded pension, the first $20,000 in pension or IRA money that you take out, if you're over the age of 59 and a half, is tax-free for you and your spouse. So her pension would be tax-free on the state and taxable on the federal.
Okay, so the first $20,000
right
would be no taxes from the state.
That's correct.
Okay. All right. Well, you answered my question.
All right. Thanks for calling, Mark.
Okay.
Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Wanted to talk about things that are taxed a little differently. I know we got some phone calls coming in, but capital gains. I just had a lady that was in a little while ago, and she's her taxable income next year is going to be about $35,000, right? And she's going to sell $60,000 of stock, long-term capital gains, next year. She's in 2018. So she said she's just so worried about the taxes she's going to pay. What do you think she'll pay, Chris, on the federal?
Well, she's single.
Single.
That's going to be, she's going to pay...
she'll be in the 15% bracket.
After the gain?
Oh, no, not after the gain.
Yeah, so she's going to pay 15%. Well, 15%.
15%, right.
Yep, on the gain.
On the gain.
Yep.
So...
what she has to be careful of, though, is it's going to make more of her Social Security tax.
She doesn't have Social
She doesn't have
No.
Oh, well then.
So that's it.
Yeah.
But the thing is, what people don't understand is that capital gains, a lot of times people go, oh, I have to pay capital gains. All those first things we talked about are taxed as ordinary income. Capital gains get a break. If your taxable income is under 15%, then you pay 0% in capital gains.
Yep.
And if you're in the 25% bracket, you pay 15%. So the truth is, you get a tax cut by selling capital gains. So it's like a deal. Capital assets are a deal. The important thing is to make sure it's long term. What's long term, Chris?
Long term is holding it more than a year.
Right. So you own it or hold on to it in your name for more than a year. And if you do, and you're in the 15% bracket or less, now 15% married joint would be this year, let's say $76,000. That would mean that you have a 0% capital gain. And so it's capital gains are a deal.
Definitely.
Right?
Definitely.
The other thing is self-employment income. That's also taxed differently. It's taxed as ordinary income, plus you have to pay 15.3% in Social Security tax.
But you get to take your expenses off from your gross income first, unlike someone who has a W-2.
Right.
So you do get a little bit benefit, but you do pay the extra Social Security tax.
Right. So we wanted to let people know that we got more, but I'm going to tell you, depending upon the type of income you have, it has a completely different way of getting taxed. Okay, let's go to Bobby in Buffalo. Hey, Bob.
Hi, how are you doing?
Good. What can I do for you?
3 very quick questions. I went to the store and noticed that I'm paying 2 tiers of taxes, Tax 1 and Tax 2. Tax 1 is 8.75% and Tax 2 is 4.75%, and it seems to be on clothing. Who's getting that percentage? Can you tell me?
Well, New York State sales tax is really 4%. Then you pay, based upon the county you live in, a county sales tax. So Erie County is 4.75. So on a normal everyday item, you're paying 8.75%. For sales tax of clothing, New York State does sometimes run specials where if you buy stuff less than $200, they'll waive their sales tax,
Which
but
would be the
Erie
4%.
County will still pay theirs at 4.75.
So they get us.
So it's not that you're paying twice. You're not paying the 8.75 and the 4.75. What Chris is saying, if the state isn't collecting their 4%, the county is the 4.75%.
I understand. I just was surprised to see that we had a two-tax tier system. And
well, they treat clothing differently and food differently.
Second and third questions, both on the new laws. The death tax, have they done anything with that? And then
Pretty much $11 million.
How much?
11 million.
And above is what they're taxing on.
Right.
And
so that most people listening, it's not going to affect them.
No, but if you have a farm or a business...
yeah, but 11 million is a pretty hefty thing, and if it's a married filing joint capital, you can actually move it to your spouse. It's like 22 million. Hey, can you hang on? I got a break for the news, Bob.
Sure.
Thank you. I'm Esther Gullius, the tax lady from EG Tax. We'll see you on the other side. Hey, I'm Esther Gullius, the tax lady from EG Tax, and we want to help you. If you have any tax questions, I will tell you all of our 30-some offices are open 9 to 9 tonight, 9 to 5, 9 to 9 all next week. Next Saturday, our mall offices are open tomorrow. Boulevard, McKinley, and Niagara Factory Fashion Outlet. I don't know what it is. Whatever you want to call it. It's up there
the one
on
in Niagara
Military
Falls.
Road. And we want to help you. If you have questions, you can go to our website and ask the tax lady. You can email them to me. I'll be very happy to answer them for you. You can call our staff. We want to help you. We just hope you give us a try. Let's go back to the phones, and we're going to talk to Mary. Hi, Mary in Marilla.
Hi. My question is the fee that you pay a personal advisor on an IRA account, can that be considered part of your RMD?
I said no.
Nope.
Okay.
I mean, you can take the money out of your RMD and pay your personal financial planner. You know, you can do that, but it's not going to be.
But their auto deduction
Right.
does not count.
Yeah.
Okay.
And the other thing you can do is you can roll it over from. You can do a direct rollover from your investment, your IRA, to a charity up to $100,000, and that qualifies for an RMD.
Okay. Is the fee that you pay for your advisor, is that a deductible amount?
Not if it's within an IRA.
Okay.
Okay?
Well, thank you very much.
All right. Thanks, Mary.
And, that's one thing. For those outside of IRAs, those fees are going away next year.
That's right. I mean, if you're paying an investment advisor right now or a tax advisor, next year you won't be able to deduct those expenses. And some people are paying $5,000, $6,000, $7,000, $10,000 to their, not to us, that's for sure, but to their financial planner.
But going back to you said about your direct transfers to your charitable, I had someone who did that, and she goes, should I keep doing that? And I showed her taking it as charity and it saved her $1,000 in taxes by doing a direct right from her IRA to the charity.
Yeah, because a lot of people might not be able to itemize anymore, so that would mean that they wouldn't have the income on page one. Right?
Correct.
And it might make their
Reduce
Social Security
the
taxable, right? So that's really important. The important thing is, and this is what we're stressing with all of our clients, is you feel really good because they changed the withholding charts, right? And you're getting more take-home pay. Well, you better be careful because we were talking on the way over here, Chris and I. Not everybody is getting a tax break. Some people are going to end up paying more taxes next year. It would be a travesty if you like a refund of $3,000 and because of situations, maybe you can't itemize anymore because or your property taxes are limited and the miscellaneous itemized deductions that you used to take are gone.
Your child turned 17.
Your children turned 17. That next year, you're not going to get a $3,000 refund. The way things are scheduled, you get a $1,500 refund, and they're taking more money out of your they're giving you more money on your paycheck, that means that there's less withholding. That may mean it's a double whammy. So make sure that before you get happy about getting that extra money, make sure that it fits into your plan.
Right.
Make sure you have a plan, right? I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Let's go to John in Tonawanda. Hey, John.
Hi. My question is this. My wife and I are both on Social Security. I have a pension, and I work part-time and make about $15,000 a year, somewhere in that range.
How old are you, John?
What? 69.
How old?
69.
Okay.
Okay, she cleans this office, and she made $5,000, but they didn't take any tax off.
Okay, so she's self-employed.
Right. Now, is there anything can she deduct her mileage to?
All right, so here's several things you can do. Why don't you do IRAs, both of you? You could do $6,500 a piece in an IRA, $13,000.
I already did that.
Traditional?
Yeah.
Okay, so you're doing that.
Yes.
So for 2017.
Yeah.
Okay, you're a smart guy. All right, so any expenses she incurred to produce the money, like for the cleaning, so she might have picked up cleaning supplies,
right.
Her travel there, maybe she bought mops and buckets and scrub brushes and whatever. Those will all reduce her profit as well. So what she pays in FICA will be less.
Okay, can you take off the mileage? Do they allow you anything?
Yes.
For mileage?
Yes, 53.5 cents a mile.
Okay, thank you then.
You're very welcome, John.
Bye.
Bye-bye. I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone. And so, for instance, had Mary not been able to take her expenses, Mary would have paid an extra $750 in FICA.
Yep.
Approximately. So that's why he wants to reduce her FICA and her tax liability by taking those expenses. So when you're self-employed, you pay at a different rate. While we're waiting for calls to come in, the other thing that's taxed differently is the sale of your personal residence. People are sitting on lots of money. I had a couple last night that said, we are just so sad. We can't get a handle on our finances. We need more money. And I said, what's the equity in your house? They said, we can't sell our house. We love our house. And a house is a wonderful thing, but many times you can use it as a tool. If you lived in the house 2 out of the last 5 years, tell them the good news.
Tax-free.
You can sell the house, and married filing joint return, the first $500,000 of gain is tax-free. So if you bought the house for $100,000 and you sell it for $400,000, the whole gain is tax-free. If every 2 out of 5 years.
Yep.
So it's remarkable
and
what you can do.
You don't have to buy a new one. You don't have to buy a house worth more money. That's
you can
all
take
old
that
law.
money and go on a big vacation or pay off all your bills. As a matter of fact, sometimes if you can use that, people that are I had another client, this is another thing that's taxed differently. If you take money out of your pension plan or your IRA and you're under the age of 59 and a half, what happens with that, Chris?
10% penalty.
And it's fully taxable. Federal and state. So I say to people, when you're looking at taking this money out of your pension plan, which they really want you to keep until you're old, because it's very holy, your pension plan, utilizing your home is a great asset. Borrowed money is tax-free, right? You can actually, and even though home equity lines won't be deductible next year, that's another thing. But you can sell your home every 2 years that you lived in yourself up to $500,000 tax-free. Okay, let's go back to the phones, and we got Mary. Hi, Mary. How can we help you?
Hello. This is kind of a confusing statement.
I love confusing.
Social Security benefit retirement statement. Yeah. And I got this probably a month or more ago, but have not been able to call. It's very confusing for me because it's got all these boxes, and it's for me.
But on the upper right-hand box, kind of in the pink part, it'll say total benefits received in 2017. Do you see where it says that? The box on the lower left-hand side is how they came up with those figures. But at the top, it'll say total benefits received in 2017. Do you see that?
Total benefits received in 2000. Box 5?
Yep. It's pink.
Yeah, it says Box 5, net benefits for 2017.
What does it say?
10,620.
Okay, so that would be the amount that is potentially taxable if you have other sources of income. Do you have other sources of income, Mary?
I have a pension and my AXA deposit.
Your IRA.
Okay, so how much is your pension approximately?
I'm receiving $902.
All right, and then how much is your AXA?
I get $1,305.
A year?
A year?
A month.
$1,305 a month?
Yes, I believe so. Yes.
Okay, so 2, 3, 1. So you're doing about 15,000 on that. So you're about 25. So your Social Security is going to be half taxable. The excess over the 25,000 is going to be partially taxable. Yes.
Okay. Now, down at box, let me see. Where is this? This is so weird.
Well, you know what, Mary?
My husband and I are divorced.
Okay, but you know what you might want to do is you might want to call one of our offices or call us later at the office, and we'll have time to spend with you, but we only have like 20 minutes left of the show. So
give us a call at 632.
Yeah, because we'll be very happy to help you.
632-7886.
Okay?
Pardon me, could I have that number again?
Yep, definitely. 632
Okay.
7886.
632-78?
86.
7886?
That's it.
Okay.
Okay, sweetie. Thank you.
Thank you. Bye-bye.
Bye-bye. I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone, and we got Jim in Tonawanda. Hi, Jim.
Hi. Couple of easy ones. Now, the mandate, there's no penalty for not having health insurance this year. Is that right?
18. Yep.
2018, not the 2017 return.
Yes, okay. And the other thing is, if someone itemizes on the Social Security benefit statement, it has Medicare Part B premiums deducted from your benefits. Is that a legitimate health care?
Absolutely.
Okay. You answered them both. Thanks a lot.
Thanks, Jim.
Yep.
Bye-bye. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You want to say something?
Nope, I'm good.
Okay, you're good.
I'm good.
All right, the other thing that's taxed differently is if you inherit property, right?
Yep.
Because if you inherit, let's say, a house from your parents, then you get a stepped-up basis. So your mom and dad might have paid $10,000. It might be worth $200,000 when they pass. If it was gifted to you, then their basis, mom and dad's basis, becomes your basis. And if that's all they put into the house was $10,000, and you sell it for $200,000, you'd have a gigantic gain,
yep.
Right? But if you inherit it, if it's after the death of the person who is bequeathing it, then you get a stepped-up basis. So if it was worth $200,000 when they passed, and you sell it for $200,000, you have no gain.
Right. So you pay no. So that's all tax-free.
Right.
Federal and state.
So it's really important. I mean, I guess what we're getting at here is you can see that there is so much complexity in the tax law. And by the way, this is next year's tax law as well as this year. There's no change in the way any of this income is being taxed. It really is important that you talk to somebody that knows what they're talking about so that you get the best bang for the buck, right?
Right.
So let's go back to the phones, and we're going to go Dave in Buffalo. Hi, Dave.
Hi, thank you. So I have a pretty simple tax situation, and I was trying to use, I guess I won't.
You can say, I don't care. TurboTax.
Use TurboTax.
Okay, good.
And I have two jobs. The first, I made $30,000
okay.
Past year.
Mm-hmm.
Second job is a simple part-time job where I only made $4,500 working on the weekends, right?
Okay.
I put in the first job, the $30,000. I plug in all the numbers and everything, and I'm looking at about $450 refund from federal and $25 from state. And then I go to put in the second W-2. Now, both of these, I'm single zero on both of them, right? I go to put in the second W-2, and suddenly I'm down to owing $400 to the state, and my federal refund was wiped out completely.
Yep.
Okay.
That's probably because you had no withholding on the second job because it's part-time. Even though you claimed single zero, the withholding tables, you didn't make enough for them to do any withholding.
Yeah, you're in the
each week.
You're in the 15% bracket, so that $4,500 is costing you $675 in income tax. Now you can skin the cat because you can put money into an IRA. So you could put. How old are you, by the way?
32.
Okay, you're 32. So you could put $5,500 in an IRA, or you could put $4,500 in an IRA. If you put $4,500 in a traditional IRA, that'll wipe out the $4,500 taxability, and you're back to where you were at square one. And you have till April the 17th to do that. April the 18th, excuse me.
Year or something, you're saying, right? So
Pardon?
This for next year?
No, this year.
Oh.
So if you have some cash laying around, and you put, and because you're not limited by your income, this is the only income you got, you can go down to the bank or your broker, you can put $4,500 or $50,000, the $5,500 is the maximum. And as a matter of fact, you would probably get a retirement savers.
Well, if he's single and he made $30,000,
he wouldn't
he's
get
over the limit.
Yeah, but anyway, so you can put the $4,500 you made, or up to $5,500 you made, into an IRA, and that'll wipe out that liability. So,
if you have the money,
yeah.
Right, I understand. So I thought something was wrong, but you're saying because it was only $4,500, they never took
the taxes out
in the first place.
Right.
Yep. So if you look at box 2 of that W-2, federal withholding would be zero or very next, like maybe
Very
$1,
little,
very
yeah.
little.
No. Let's see. The federal withholding was $323
on the
$4,000.
$4,000.
Yes.
All right. How much was your original refund?
$400.
No. So
how much was your original refund, Dave?
It was going to be, before I put in the $4,500, it was going to be like $450 federal and $25 state.
Okay, well, that would mean that you should still get a refund then. So you've done something wrong. So I don't know. I can't tell. I can't look at your TurboTax program. Double check all the numbers you put in.
Yeah, okay.
Okay?
Okay.
And think about that IRA, too. All right, bye-bye. Thanks for calling. I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930.
$4,000, it's 15%. You're looking at $600. He has
Well, I said
$300
$675.
withholding. So, yeah, that would wipe it pretty much out because he wasn't withholding 15%.
Well, but no, he had a $400 refund.
Right, and now...
So $400 off the $675 would bring it down to $275. Yeah, he'd be in the hole.
Yep. So,
okay.
And it's Lola on line 5.
Lola. Okay. Hey, Lola, how can we help you, ma'am?
Esther, I just wanted to clarify something I thought I heard just a little while ago on your program. Did you say that on your ordinary pensions, like from your employment, that there was first $20 was non-taxable?
$20,000 on the state.
On the state.
Only on the state, not on the federal.
Oh, okay, because I thought you said federal and the state.
Oh, no. On the federal, they're sitting there hoping and praying. But on the state, you're good to go.
Darn.
Okay, sweetie?
And one other question. Would you please repeat the new tax brackets for 2018?
Oh, I can't. I don't. But I will tell you. You can call our office. We'll point you.
Right on our.
It's right on our website.
I don't have access.
Okay.
Oh shoot. Well, if you call the office, they'll print it up and send it to you. So call 632-7886, and they'll mail it to you. Okay, Lola?
Okay. Thank you.
Thank you, sweetie. Bye bye.
Someone texted in help. If you need tax help, give us a call here or text what you need help with.
That's right. That's right. Before we get to the other phone callers, 8030930, 8030930, star 930 on a cell phone. The other thing is if you're somebody that has investment property and you want to sell it, let's say you're in Buffalo and you want to go to Florida, you can take your Buffalo investment property, maybe you got a rental, and you can exchange it for other property in Florida that might be rental property, and that would be completely a non-taxable event. That's called a 1031 exchange. So that's another thing that's different in the tax law. And the other thing is, if you're selling property, you can hold the mortgage, and that's called an installment sale. So instead of paying the taxes up front, you can pay a little at a time as you get the gain.
Yep.
Right? Okay, let's go back to the phones. 8030930, 8030930, star 930 on a cell phone. We got Marcia in Amherst. Hi, Marsh.
Hi, Esther. How are you doing?
I'm good.
I just have one quick question. For 3 months out of last year, 2017, I was on unemployment. I was without a job. I have not received anything from the state.
Yeah, I know.
Showing me how much money I got. What do I do about it?
Yep, that's because New York State, in their great wisdom, decided to stop mailing them out. You have to go online and print it out yourself, or you can call them and they will mail it out in about a week or 2 weeks.
Okay.
All right, so if you know your username and password, the same username and password that you use to get your weekly benefits, that's what you do. You just look for the...
Under payments.
Right. There's a 1099 form you would print.
Okay.
All right? Thanks, Marcia. Bye-bye. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on cell phone, and we got Jim in Eden. Hi, Jim.
Yes, hello, Esther.
Hey, what's happening?
I own a C corporation, and I file my taxes on Form 1120.
Yep.
My question is this. I know the new federal tax rate is 21%, but are there brackets also? There
Yep.
used to be.
Yep, there's new brackets. Give me an idea. Do you have is it a big corporation you have?
No, I used to be in the 15% tax bracket. It was under like a $35,000 taxable.
So I'm just wondering, why are you a C Corp?
It was the way it was structured.
But you know you can make an election, Jim, to be an S Corp. And then you could take your net profit, and instead of paying double taxation, which you're paying now, you could just pay once, and it'll flow through to your personal return. We change a lot of people from C Corps to S Corps, and it's a very simple procedure.
All right, well, I'll have to consider that, but do you know if there are still there's new rates for C Corps?
Yes, there's going to be different
Yeah, there is,
brackets.
but Jim, listen to Mama here. You pay double taxes on a C Corp. You're going to pay on the corporation's going to pay taxes
on the net profit.
On the net profit, and when you take money out, you're going to pay taxes on the dividends. If you make the election, what form do we use?
A 2553 for the federal.
2553 and a CT6 on the state. You make this, fill out this little form, and then you get to pay, if you're in the 15% bracket federal, that's what you pay on your corporation. And I would tell you, Jim, I really seriously think you should, I don't think it's something you should consider. I think you should really, really consider it.
Okay, thanks.
Okay, thank you, sir.
Yeah, because a lot of people don't realize that. He's paying, say his net profit was $30,000. The company's going to pay 20 on the new tax rate. We'll say 20%, keep it simple. So they're going to pay $6,000. Well, when he takes out that $30,000 and puts it in his own bank account,
he pays again.
He's got to pay a tax on that $30,000
But
again.
if he makes an election, it is taxed once at his personal rate. How many corporations? A lot of times people get set up on a C Corp, and they really should have never.
They
but
don't
you
know.
can make the election. You can move from a partnership to an S Corp by filling out a simple form.
Yep.
Okay, we're going to go quickly here to Jack. Hey, Jack, how can we help you, sir?
Good afternoon, Esther. I have a beneficiary CD IRA worth about $3,500. I wanted to cash it in, and I wanted to pay the taxes up front. Now, they told me 2 percentages. You don't have to pay nothing. They could take it out next year, or you could pay the taxes up front. I guess federal would be at one rate and state would be at another rate. I just want to pay them where I don't get stuck underpaying and have to pay.
I would do 20% to the federal and 5% to the state.
20 and 5.
Well,
Because
how
you'll get the
old
money
was
back.
the person who passed away?
I'm sorry?
How old was the person who passed away?
My father was like 70-something years old.
Okay, and do you have any other pension income?
Oh, no.
Then you don't need anything on New York State because his $20,000 exclusion would flow down to you, so that money would be tax-free on New York State. So all you need to do is 20% to the federal.
And then you'll get that money back next year if it's too much.
Yeah, okay, because somebody tried to guide me 25 for federal and 15 to the...
No, Chris is absolutely right. Because you're the only heir, and he was over the age of 59 and a half, the $20,000 exclusion we've been talking about on the show would be available to you because you have an inherited IRA to somebody who's over the age of 59 and a half.
Alrighty.
Okay, thanks, Jack.
And then, speaking of IRAs, the person just texted in, can you hold a Roth and a traditional at the same time? And yes, you can.
Most definitely can. Yep. Well, I'm telling you, we're going to rush back to the office right now. We're going to we didn't take a break. We're going to short our program here. And so what we're going to do, if you guys need us, if you need the best tax help for the most reasonable fee, is EG Tax is there. All 32 offices are there to help you 9 to 9, Monday through Friday. Give us a call. Our website is egtax.com. Until next week, I'm Esther Gulius with Chris Fabian. Have a great week. God bless. Bye-bye.